Well, greetings, Series 7 test takers. This is the Series 7 guru, Dean Tenney, coming to you from my studio here in fabulous Las Vegas. This is the fourth installment on suitability in the Series 7 playlist. I may break it off and make it its own separate playlist. We have 60 minutes on suitability. That's in the playlist already. I'll probably link to them all so that you can find them all readily in the video description or a pinned comment. But we also have suitability, yes or no. We have 50 suitability practice questions, and now we have 40 case studies. These questions come from when I teach class, we have time to do exercises. We do so. Don't ask me for a copy of the PDF. I mean, you need to sign up for one of my classes and come to that. This is a free supplement to your paid study materials. This channel is not set up to be supporting sending you things. So maybe next year there'll be a website, maybe some point in the future you can request and pay for PDFs, but that's not where we're at presently. So don't be asking me to send you copies of slides or PDFs or anything like that. Anyways, that being helpful, being said, I try and be as helpful as possible in terms of you're using this as an audio podcast, or if you're using this as on your smartphone, trying to let you know what you're looking at. Okay, number one. 40 case studies begins with the first case study, suitability. Your clients are both professionals in their late 30s and they have two children, ages 10 and 7. So I first think, okay, well, it looks like we're probably going to be thinking about college education here. That's a common investment goal that people have. So I'm thinking maybe we're going to be talking about a Coverdale or 529 or a zero coupon bond, something like that. In the past 10 years, they've allocated adequate savings toward growth and wealth building. So it doesn't sound like it so far it's about them. It sounds like, once again, the focus is on the kids. They've allocated toward growth and wealth building. With an additional $150,000 to invest, they're looking towards college funding now. So we were right. So the question is kind of tilting towards where we thought it was heading, which is about college funding now. Of the following, which would be a suitable recommendation for these additional investment dollars aligning with this profile? Well, right out of the gate, I have some zero coupon bonds and some treasury notes, 80% zero coupon bonds and 20% treasury notes. By the way, whether it's a mutual fund or individual securities, it kind of would be similar, but sounds pretty good. Let's see what my B choice is. Equities, 60% equities, and 30% T-bills and 10% corporate debt securities. And yet 30% in idle cash doesn't sound like that is very helpful for me. I think I'm going to go for A here because that actually kind of fits what it sounds like we're looking for. So I'm going to say choice A looks like the suitable portfolio. And then what we would do is have those zero coupon bonds maturing, and it looks like for the age 10 kid, have zeros that are 8 years out, and for the 7-year-old, zeros are perhaps 11 years out, and some treasury notes 2 to 10, same deal. Maybe I make them mature at that same thing. So that looks like that's my best answer given that suitability question. Listen, please do not start commenting about you have some other recommendation. Stick with what's offered to you. You're only being offered two choices. You have to take the best of the two choices. And I don't want to argue with you about whether you think B is better. That's not the point. You know, I miss suitability questions all the time because I think 90-year-olds should be fully equitized, but you're trying to answer what would be prudent given the suitability. Number 2, a retiree, she's widowed, or a retiree widowed he is a widow, his early 70s, has adequate savings to meet large unexpected expenses. However, he has no pension or IRA, and in some months, Social Security payments leave him short, requiring him to dip into his savings and investment for recurring expenses such as his mortgage payment. So I see mortgage payment, I think that's a monthly expense. I see utilities, I think that's a monthly expense. With an already diversified portfolio, he wants a way to add to his monthly income. Key, that's a hint, monthly income. He's willing to liquidate and allocate up to $100,000 of his current portfolio or cash out of a life insurance policy if may be to meet this objective. Which of the following recommendations would be better? A variable annuity, Ginnie Maes, yeah, very testable under the Ginnie Maes, pay interest and principal monthly. It is the only investment we have that pays interest and principal monthly. And it sounds like that would be nice. He's getting those monthly payments from his Ginnie Mae investment that pass through to him, because that's how people make their mortgages, and that's how it gets passed through to the customer. So there's no debate on this one that B is the most suitable recommendation. Variable annuity is totally unsuitable given this fact set. Remember, Ginnie Maes have the full faith and credit of the United States government, and they're fully taxable. Again, very testable. So I'm commenting beyond this 40 case studies here on the things you need to know about these investments, because suitability and the investment vehicle are linked, right? You know, put the wrong driver in the wrong vehicle, and you know what the characteristics of that investment vehicle are. So the answer to 2 is B. All right. A customer who has been funding a self-directed IRA since her late 20s is now in her early 60s. Wow, 40 years plus. The investment vehicle currently is weighted heavily towards equity for growth. So it looks like we might want to change the asset allocation model here. I mean, I'm not so sure if she's in her early 60s and it's been a 40-year ride that she should be, you know, still investing for growth. Has allowed her to accumulate a robust nest egg to be used during retirement. Ooh, I love that, a robust nest egg. Considering all of mutual funds, all mutual funds, the IRA is currently diversified as follows. So she has 70% in growth funds, 20% in corporate bond funds, and 10% in sector funds. Sector funds are pretty aggressive, and a growth fund is pretty aggressive. She has 80% of her assets in a pretty aggressive asset allocation model. So it sounds like what we're going to do is probably take her down on the 70 and the 10. So that's what I'm kind of looking for in my answer set. Anyways, hoping to keep the IRA investments limited to mutual funds. So she's saying she's comfortable. She likes mutual funds. She knows how they work. So she wants to stick with mutual funds. She asked for a better allocation given her age. Which of the following is a better allocation? There's nothing in this question. There's nothing in this question that says anything about her tax bracket. And for the answer to have something to do with her tax bracket or munis, they got to tell us she's in an uncomfortably high tax bracket or something about taxes. So I can toss a B out of there, or excuse me, A as an atom out of there, because again, for it to be a municipal bond fund, there's got to be something in her taxes. Don't bring extra stuff into questions. I had a guy who missed a question yesterday because he said he thought she needed some tax-free income. I said, what in that suitability scenario had anything to say about her taxes? So don't be bringing extra stuff into questions. Choice B says, I'm going to put 60% government bond funds, 30% in index funds, and 10% in growth funds. Again, do I like that? I probably don't, but that's not the question, right? You got to stick to the answers provided to you on the test. My only choice is A or B. So I don't like B, but it looks like that's my only choice, so I'm taking it. And let me put that down there. It looks like this is the one we're going to take, which is B. Number 4, a young couple in their late 20s wants to begin searching for their first home. This shows up quite a bit. So I'm thinking they want their first home. I'm thinking their time horizon is a little short. You know, I don't know how long they want to wait before they get their first home. My guess is sooner rather than later. They have a wish list regarding location and amenities and a budget. They are realistic, knowing that finding the right home may only take a few weeks, but could take several months. So again, that's just confirming what we thought, is that the time horizon is rather short. Their question is what to do with $50,000 they've saved for the down payment. Which of the following lists presents the better options? Savings account, money market, T-bills. That sounds pretty damn good. Long-term bonds, no. Right? Interest rates go up, the bonds go down. U.S. government notes, Treasury notes, mutual funds. No, I think that's anytime we have this short time horizon, we're looking for money markets. We're looking for, CDs. We're looking for cash, T-bills. And so given this answer set, it looks like our best one is going to be choice A is our better model there. Number 5. Let me clear up my slide. A debt fund manager, extremely sensitive to interest rate risk, has taken the opinion that interest rates will begin to come down. So he's thinking interest rates are going to come down, the bonds are going to go up. But remember, there is risk there. I think what I'd be thinking here, if I'm a fund manager and I'm thinking interest rates are going to come down, it sounds like what I might be worried about is call risk. Very testable. Call risk is associated with a declining interest rate environment. So what I'm afraid is that they may call the bonds away from me. With that opinion in mind, which of the following would be a better recommendation? Well, given this answer set 5, the answer is B. I would buy some non-callable bonds. The two major non-callable bonds to be aware of on the exam are zero coupon bonds and Treasuries. Treasuries are non-callable and zeros are non-callable. So the answer to 5 is A, or excuse me, oh man, sorry about that. I said it right and almost clicked the wrong button. The answer to this one is non-callable, which is choice B, right? I'd get some zeros, some Treasuries. Definitely would know that call risk is associated with a declining interest rate environment. I would definitely know zero coupon bonds have no call risk. I would know Treasury bonds and Treasury notes have no call risk. I would know call protection consists of two things: the call protection period, the time, how long before they can call it away from you, and the price. What is the call price? And the answer to 5 is B. 6. Your client, a wealthy business owner, owns 40,000 shares of a stock that was amassed over many years. So I'm thinking, okay, he's been buying different numbers of shares at different prices over the many years. Yeah, and I'm thinking maybe this is going to be something about whether it's share identification or LIFO or FIFO. Who knows? That's what my first kind of thought is as I read this first sentence. With this single holding equaling close to 5% of his investment portfolio, the risks have been identified, discussed, and ultimately acknowledged and accepted by the client. Suddenly, adverse, unexpected news regarding the safety of a key product sold by the company sends the stock down, losing over 10% of its value in a single day. So this doesn't sound like this is systematic risk or market risk. This sounds like it's non-systematic risk or selection risk. Not every stock has tumbled down today, just this stock based on its unique circumstances. Regarding suitability, while a number of risks could have been discussed, which risks shown here should have been discussed with the client? And so the answer to 6 is going to be A, right? Credit risk, legislative risk, and lack of diversification. I think that's the better answer. I'm eliminating. I don't like, again, on these questions, I don't like, I would prefer some other questions that are a little more, aim and shoot, point and click oriented, but it certainly seems like lack of diversification. Anyways, market risk, no. The risk that we were exposed here wasn't market risk. Timing risk, no. Lack of diversification. I think C6A is the, both of them have a lack of diversification, but it's again, I'm eliminating and saying it's A. And the reason Dean is saying it's A is because, again, it's not market risk. So that's why I'm saying it's not, I'm going to eliminate B and go with A, because this isn't a function of market risk. It's not a function of timing risk because you've been accumulating it over several times frames. So again, welcome to the test. That's, like I say, not my favorite one, but oh well. Number 7, an investor age 42 has a portfolio mix that's 70% equities for growth, 30% debt instruments for income. The growth portion is spread across several individual stocks and 3 growth-oriented mutual funds. This investor is comfortable with the risk, with the current asset allocation, but wants to hedge some downside risk for the equities if possible. Which of the following is most suitable? Now, if he was worried about a particular stock, we would buy puts on that particular stock if he's worried about non-systematic risk or selection risk. But it doesn't say here that he's worried about a particular one of these securities. He's worried about his entire portfolio. And so I think what the idea here would be to do is buy puts on the index that most closely approximates his portfolio. C is going to be a lot more efficient than is buying puts on each of the individual selections. And then how would he do that on the mutual funds? So that's just a lot messier, a lot less inefficient. And so the best answer here is C, buy puts on the index that most closely approximates his portfolio. Let me put that in there. Boom. You know, I think of a scenario where my manager calls me and he says, "Hey, Dean, why did you buy puts on each of these individual stocks in his portfolio?" And I say, "Well, because he thinks the market is going to go down." And I say, "Well, listen, but why not just buy an index put?" And he goes, "Well, I get less commissions." I believe that'd be a bad answer. It'd be a bad answer. So what your client is worried about is systematic risk, risks in the system, market risk, the tendency of securities prices to move together. We don't buy puts on the individual stocks or funds. We buy a put on the index that most closely approximates the customer's portfolio. The idea here is that for every negative correlation for the money I lose in the portfolio, as the portfolio goes down, the intrinsic value of my puts go up. Number 8. Your client, age 28, has just begun to consider investing outside of her employer's 401k. She saved $25,000 to allocate toward a growth-oriented investment. That's key, growth-oriented investment, but prefers an investment with moderate risk and moderate risk. So that's kind of a little conflict, right? She wants growth-oriented business, but she wants moderate risk and some downside protection. With investing being new to her, she wants to note that she understands as comfortable with moderate risk is stated only. Given what has been conveyed, which of the following would be most suitable? Well, because she mentioned this moderate risk thing, I'm going to go with the A, the balanced fund, just because the growth-oriented mutual fund, the equity index fund, that's a little too aggressive based on that comment about moderate risk. So we're going to go for number 8. We're going to go for A. We're going to say, let's get a balanced fund. Balanced fund would give her some protection against the market going down, because we're assuming the bonds, stocks and bonds here, right? The debt instruments would, offset the equity investment. So the answer to 8 is A. Oh, by the way, like all these questions that we put on the channel for you, you could always just stop, hit pause, come up with your answer, read the question, or after I read it to you, if you're using audio, then pick your answer. 9, a customer having signed the options disclosure document, very testable, know that you have to sign the option agreement within 15 days of account approval. Otherwise, we're only going to let them do closing transactions. Very testable. Anyways, it sounds like I've got the option agreement already signed. You've been approved. Ask the revenue ruling, the revenue ruling, this looks like a typo, to simply not recommend or suggest any options where the risk of loss is unlimited. So we should definitely know that if we do naked calls or uncovered calls, that has unlimited risk. And so short straddles has that. We should have been able to eliminate the short calls and short straddles, because remember, the person said, the client said they don't want to be exposed to unlimited risk. Knowing this, would not recommend. And so we're not going to recommend A. We're not going to recommend A. Let me get out my, right, because short straddles have a short call embedded in them. And so we wouldn't recommend that. Long calls, you lose your premium. Long puts, you lose your premium. Spreads, you only lose, the most you can lose of a debit spread is the debit. And a credit spread, all you can lose is the difference in the strikes less the credit. So that has limited risk, meaning, again, the answer is A. Would not recommend. Clean up my slides. 10, an investor with a well-diversified portfolio. An investor with a well-diversified portfolio wants to allocate 25% of the portfolio in such a way that it will mirror the overall market's performance. So I'm thinking index fund, right? Because an index fund, whatever the market does, the index fund does pretty damn close. It has a beta of 1. Remember, beta is a measurement of the volatility as compared to the market as a whole, the market being represented by the S&P 500. So I'm thinking index fund here. The investor is comfortable with market risk and in a financial position, earning $180,000 annually, not quite accredited, but getting close, right? To assume such risk. The investor is not comfortable with high portfolio turnover ratios, leading to high transactions and management fees. Again, sounding more like an index fund recommendation here, right? They're thinking there's not added value here in terms of active management. Of the following, which would be a suitable recommendation? That's, I think, a pretty easy one. We've had some that were kind of like, yeah, I didn't really care for, but this is pretty straightforward. That's going to be an index fund. So both 9 and 10 were pretty straightforward in terms of what our recommendation would be. Number 11. A client with an annual income of $62,000 and an investment portfolio of $125,000 has taken an opinion on a particular company's stock. The company has several new products, and all have been in the news lately, but not all the reports have been good. Earnings and sales figures are due to be reported to shareholders, and no one knows how strong or lackluster they may be. The client does not own the stock, but is of the opinion the price will be volatile when these numbers are released. Yes, what might be an efficient way to gain if that volatility occurs? So it looks like to me what this client is kind of hinting at is they think it's either going to be good news or it's going to be bad news. And that sounds like what we want to do is buy a straddle. I say, why don't we buy a call and buy a put? And, we don't care if it goes up or down, just as long as it moves and we can cover our out-of-pocket cost. So the answer here is C, purchase a straddle. There are 4 test questions on straddles on your Series 7. Can you identify a straddle? Can you calculate the break-evens? Can you determine where the straddle is profitable? And then this question, when do you use it? And so this question 11 is about when do you use a straddle? So the answer is C. 12. You recognize that a registered rep should work with clients to identify their investment objectives and comfort level regarding the different types of risk. Okay, fine. Not really a hint there in that first sentence. If near-term liquidity, there we go. Now that's a nice hint. Near-term liquidity were the only objective, which of the following pairs would represent the most liquid and the least liquid? I'm just trying to help myself out on the grammar there, right? So I could probably go backwards on this one and say, well, let me go with least liquid. I think I'm going to go right out of the gate and say, hey, direct participation program, very testable to know that that has no liquidity. You can't get in or out of a direct participation program, AKA a partnership, without the permission of the general partner. So that seems like me least liquid. And listed common stock, New York NASDAQ, that sounds like a good answer. I'm taking A. Now let me see what my other choices are. T-bills, you got this wrong. T-bills are the most liquid investment. There's no more liquid market than that for Treasury securities. A variable annuity, no, variable annuities are not liquid. So given that answer set, A is certainly it. I always use the example of Steve Ballmer buying the Clippers. You bid $2 billion and you just sold $2 billion worth of Microsoft stock, and on T+2, he had the $2 billion he needed. The Microsoft stock is very liquid. Number 13. A married couple in their late 50s with a $210,000 combined income are looking toward their retirement, which they anticipate for each of them will be in 6 to 8 years. They are clear that their risk tolerance is very low, that sounds like a hint, and have no desire to play the market, that sounds like a hint. With this information only, which of the following would be more suitable? So again, they're on the test, is very much like the test. They ask you, given imperfect kind of answer sets, what you'd pick. And it looks like they said the risk tolerance is very low. So I don't think I'm going to have corporate bonds and preferred stock in there. I think our best answer, given this answer set, is going to be choice B. Right? Treasury notes, no better credit quality than the U.S. Treasury. Municipal bonds are considered the second safest form of credit after that. And Ginnie Maes have the full faith in credit. So I don't like there's muni bonds here. It kind of doesn't tell me about their tax bracket, but If they are making $210,000, they're going to be in a high tax bracket. So I would prefer that point blank there was a better hint here about munis being potentially the right answer. But again, we have to go with what the answer sets were given. A sophisticated investor with a diversified $4 million portfolio wants to invest $100,000 in an industry sector that she is bullish on. Okay. Understanding the difference between commissions and sales charges and being comfortable with both. She knows two other criteria are important to her. So that's kind of key. So I wasn't sure what this, this thing about commission and sales charges are. She knows two are important. First, she hopes to use leverage. Ooh, there's a hint. This purchase in a margin account. So boy, that's being very helpful. So with $100,000 to invest, that means she can now invest $200,000 if she's going to do it in a margin account. Well, there you go. They just told us that, but you should have known that. Finally, she notes detesting year-end tax statements showing unrealized capital gains tax liabilities. Usage suggest, again, I don't really like this one. But, based on this, the ETF is going to be passively managed, whereas a sector mutual fund is going to have active management. So here's another one I'm not a big fan of in terms of this, but given the conversation about she doesn't like the year-end tax statements showing unrealized capital gains and liabilities, the ETF isn't going to do that. And the ETF, the other trick in this is ETFs can be purchased on margin and open-end mutual funds cannot. So that's another hint here. It's not a sector mutual fund because you can't buy mutual funds on margin. So given that I've eliminated that, now B is becoming even more appropriate as an answer. Make sure on your test you can distinguish and compare and contrast the difference between open-end and ETFs. It's very testable. There's more than 2, 3, 4 questions on that. And remember, ETFs trade supply and demand. Uh, 15. An investor wants to purchase a fund that tracks and moves with a popular index to add some diversification to an existing portfolio. Okay, so it sounds like, again, we're looking at an index fund. Yeah, it moves with an index. The investor has discussed being comfortable knowing that the investment will rise or falls with the index, but any risk of falling beyond what the index might fall is not within the investor's comfort zone. Which of the fund would not be suitable? And given that they just said not comfortable going down, remember with leverage, the same supercharged speed you make money with is the same supercharged speed you lose money with. And so, we wouldn't recommend the leveraged index fund. The answer is A as an atom. 16. A married couple in their late 20s wants to save for their daughter's college education. So again, I'm thinking zero coupon bonds, Coverdale, 529. That's what I'm thinking. She's 4 years old, so it looks like we have 14 years to go. They're going to do $500 a month. So it sounds like maybe a dollar cost averaging scenario where, we're going to have fixed dollars invested regularly. They're very concerned. By the way, 500 times 12 is 6,000. So, I'm thinking that throws out the Coverdale, right? They're very concerned about inflation, what college will cost, but they're also concerned about market risk. But what do we recommend? Almost always the 529 is what they're looking for on the test as the winner in a beauty contest with a Coverdale. Remember, Coverdales are means tested and they have a cap, and 529s do not. So the answer to 16 is B as in boy. And remember that 529, the funding for that, the $500 a month is going to go dollar cost average in a mutual fund kind of thing. So the answer there is B. And remember, we can front load that for 5 years. 30 minutes, we're at the 30-minute time clock. And what I always tell people is if you're doing these things, you want to take a break, there's always a pause feature. So hit pause, come back to it if you'd like. I'm going to continue to march because I'm trying to get this thing done for you so I can get it on the channel. 17. Jim is 35 years old and makes $75,000 a year working for the ABC Corporation. His company has a 401k and he contributes amount equal to the 3% match. Jim is a smart guy. I mean, where are you going to double your money pre-tax? He wants to do more for retirement, so that's a hint, outside of the 401k. So He's maxed out that. He likes the idea of a tax-free income when he retires. So, boy, you wouldn't put a muni into a retirement plan. Maybe he was in a high tax bracket, and here and now a muni might be good, but no. What would you recommend? A non-qualified variable annuity? Oh, no, it sounds like this is a good idea for a Roth, right? Those Roths have no required minimum distributions, and you can draw the money without paying taxes on it. So that's pretty cool. So the answer there is a Roth, and the distributions for that will be tax-free. I think the Roth question should be legislative risk. I mean, Senator Roth is here no longer to protect his Roth IRAs, so, and no required minimum distributions either. 18. Archie and Phyllis are in their 40s and make a combined $400,000 adjusted gross income. Woo! I'm thinking accredited investor. They have $100,000 and like to invest with no specific goal, but would like to conservatively invest the money. They'd like to reduce tax exposure. So I'm thinking muni here because 400 grand in adjusted gross income, and they just told me reduce tax exposure. They said they want to have access to the funds. So this is looking more like it's going to be some kind of a tax advantaged investment. Which of the following would be most suitable? And yeah, I think the muni bond exchange traded fund where they can buy and sell it like a stock seems like the best way to proceed here. B is in boy for 18. 19. Jill has $150,000 investment portfolio that split 70-30 between blue chips and utility fund. Boy, that sounds very, as equity investment goes, that sounds pretty conservative. She would like, but by the way, it is still 100% asset allocation to stocks, right? Blue chip stocks and the blue chip stock mutual fund and the utilities and the utility mutual fund. She'd like to increase diversification of her equities and reduce the overall risk of her equity portfolio with an additional $20,000 investment. Which of the following investments would give Jill the greatest diversification? And I have an international stock fund. I'm going to go with the international stock fund because we're hoping the international stock fund would have different correlation to what she already has. And that Silicon Valley stock fund, a sector fund, is going to have a more positive correlation. And so given I have A or B, A is more different and would add additional diversification. So I'm going with A in that scenario because I'm hoping for negative correlation, and negative correlation again actually adds diversification. 20. A customer age 50 is not happy with the income from his money market mutual fund not keeping pace with inflation. So it sounds like just from that first sentence, we're looking for something that would keep pace with inflation. You know, it doesn't say beat inflation, it says he's unhappy with not keeping pace with inflation. The yield is lower when factoring in the interest is taxed at all levels. Okay. You know, I'm not sure what that has to do with it. What recommendation could you make that would provide an income that keeps pace with inflation and provide some tax relief? This is pretty straightforward on this one. We have some that the answer is going to be a tip, right? A Treasury inflation protected security. You're definitely high probability. I don't know if any draw in your Series 7, you're not going to get tested about a tip. And then remember, the state would like to tax you on interest you receive on Treasury debt, but cannot. And so you're going to have to pay federal income tax, but not state income tax. So that fits that second sentence. I don't think that's a big deal. But tips are going to be semi-annually adjusted the principal value by whatever the consumer price index does. So you're keeping pace with the consumer price index. No doubt in the question 20, the answer is A, and you will see that on your exam. This idea of tips keeping pace with inflation. Now, if it said beat inflation, then we're looking for some common stocks. 21. A couple, 40 years old, owns Best Jewelry, a retail jewelry store. The number one objective is to save for their retirement and provide a plan that employees can also use for retirement. They're not afraid of the risk with the equity markets. What's the best choice? Well, you should have been able to eliminate the 403B because it's not a nonprofit. It's not an educational institution. 403Bs are for educational institutions, and this is not an educational institution. And so given that I know that or should know that, that leaves me with setting up a 401k for the jewelry store that would take care of, that they could contribute to as well as their employees. So the answer to 21 is B. A prospect, 22. A prospect you are working with is 60 years old. And remember her parents' bond portfolio losing significant value in the late 70s and early 80s when interest rates went up. Yeah, interest rates went up dramatically. As a result of living through these turbulent times, she wants less interest rate risk in her portfolio. She is looking for something conservative that will generate income and maintain ability to withdraw sums of money as needed. She's not interested in investing in the stock market. What would you recommend? Now, sometimes they're giving us layups because when they say she's not interested in involving in the stock market, that just kind of gets rid of choice B. And so that leaves us with choice A. You know, a bond laddering strategy is where I have a bond portfolio where we always have some bonds coming due, laddered maturities, 1 year out, 2 years out, 3 years out, 4 years out. We always have bonds coming due that we can reinvest at today's interest rate. And so that's a bond laddering strategy. I think this became pretty easy based on process of elimination once they said in the suitability setup here that she doesn't want to be in the stock market, right? So where does it say she's not interested in the stock market? So B just goes off the table immediately. 23. A customer believes that the banking industry is going to go through a consolidation over the next few years. In her opinion, there is an opportunity to profit on this industry consolidation. You agree that this could generate profits. You recommend which of the following? I kind of like this question. I like it. Special situations are like story stocks. Hey, let me tell you about this special situation, what's happening in the banking industry right now. So yeah, the answer there is A. It is certainly A. And so given that answer set, buy calls, no. Right. And by the way, the large cap banks are going to be the predators and the small cap banks are going to be prey. And so usually the person who's buying the bank, doing the acquiring, they're not the ones that are going to go up as much as the banks that are being acquired. So anyways, the answer is A, special situation fund. 24. You have been referred to a prospect who's 25 years old, has never invested before. Ooh, kind of a hint here. I better be gentle, When filling out the the small amount of money to invest monthly. So sounds like fixed dollars invested regularly. Sounds like dollar cost averaging to me. When filling out the customer profile, you note the prospect has less than 3 months of living expenses and cash reserves. A goal is to purchase a home within 2 to 5 years. So here we go again with this home purchase. So at first I was thinking long-term dollar cost averaging, but then it said less than 3 months of living expenses. And then it says, want to buy a home. So based on those additional suitability inputs, it looks like 24, the best answer is going to be B. B. And once they get into the house and we can revisit this, but based on this scenario as of today, it looks like B is the most suitable. Let's see. A says invest in a balanced mutual fund so that a portfolio of stocks and bonds. No, that's out because of the cash reserve and the house thing. C, open a long margin account. And that's just out from the minute it said margin, right? Joe Sixpack should not be opening margin accounts. 25. A client calls you and wants to purchase stock of a foreign company or an American depository receipt representing the shares of that company. The company has had strong earnings over the last several quarters and has a dividend yield that fits with this goal of growth and income. You feel it is accurate and important to discuss that from a suitability perspective. So ADRs are very high probability on the test. And, if they're collecting the phone bills, I always use Teléfonos de Mexico, and they're collecting the phone bills in pesos. It used to take 10 pesos to get a buck, and now it takes 20 pesos to get a buck. Very testament that ADRs do expose you to foreign currency risk. And so the answer is A. If the underlying business is conducted in the foreign currency, then you're going to be exposed to the foreign currency risk as an owner of either the foreign security in the foreign market or as the owner of the ADR in the US market. You should definitely know ADRs facilitate U.S. citizens owning foreign securities. And you should definitely know this 25A here, that you're exposed to currency risk. 26. A customer has owned rental properties for many years, so comfortable with real estate. She just sold one of the properties that had been for sale for 6 months for less of a profit than she thought she was going to get. She would like to invest in more real estate, but does not want to maintain the property, deal with late rent payments, or have to wait months if she needs cash and has to sell the property. Which of the following choices would be a suitable alternative to buying another property? Now, with the minute that we see here, she doesn't have to wait months to get cash. We can eliminate in 26 choice B, because we should definitely know in a direct participation program, you don't have liquidity, right? Because you're going to need the permission to get in or out. So now we have to decide, it's a REIT. We now know it's a REIT, real estate investment trust. You buy a REIT for the same reason you buy a mutual fund: professional management, diversification, and ease of ownership. But you're not buying a diversified portfolio of securities. You're buying a diversified portfolio of real estate. And you should also definitely know that both mutual funds and REITs don't pass through losses. They pass through at least 90% of net investment income. Anyways, I have to decide between the mortgage REIT and the equity REIT. So I'm going to go back now. I'm looking for a hint. Customers own rental properties. She sold one. She would like to invest in real estate, but does not want to maintain the property to deal with it. Have to wait months for it. She has to sell the property, which of the volumes would be similar to buying another rental property. So that means now I know it's C, because she wants exposure to owning real estate. So the answer there is C. Currently, investors have a bearish outlook on the stock market. Your customer, a sophisticated investor, would like to invest in something that will generate income during the current conditions, and also like to take advantage, but would like to take advantage of capital appreciation should that occur when the market sentiment turns bullish. Which of the following could be purchased to put your client in a position to do both? Key word: to do both. So what I want is an income stream and potential upside gain, and that certainly sounds like a convertible bond. So, we get paid to wait, basically, right? A convertible bond, we get our coupon payment, and then if the stock rebounds at some future point, we can convert the bond into stock if it makes economic sense based on parity. Can't stress this too enough. On Series 7, you're going to have to calculate parity. So here it says, the key here is generate income. So that means A is out, generate income. Capital appreciation means C is out. So that leaves us with B, a convertible bond. You get the upside of the stock and the income of a bond. 28, inflation is rising and the government is expected to take action to reduce the money supply and contract the economy. But welcome, I'm coming to you and I know the internet is forever and the channel is forever. Dean may not be here, and who knows, the channel may be still getting clicks. That being said, this is exactly what's happening in today's environment where I'm making this video. Which of the following securities would be least likely recommended for a customer that needs a specific amount of money? So least likely, right? That's important, least likely. So that means I can toss out the choice A because that's most likely. So which of the following would be the least likely recommendation for a customer that needs a specific amount of money in 5 years? Yeah, the zero trans CMO is a speculative investment on interest rates. And so the answer to 28 is B. CMO, boy, when you go for a zero tranche on a CMO. Now, I don't think you're going to see a zero tranche, but make sure you know the difference between PACs, plan amortization classes, and tax targeted amortization classes, and know that PACs have more predictability and less risk than tax. Make sure you know there's a suitability statement required to sell a CMO because it's a derivative. You're buying a cash flow, a tranche, a cascading cash flow. Tranche is French for slice. You're buying a cascading cash flow. Anyways, the answer to 28 is B. 29. A customer owns a variable annuity. A customer owns a variable annuity and would like to begin distributions from the contract. So it sounds like they want to annuitize. They want to annuitize. The main concerns are maximizing monthly income. This is very testable. So they're asking, the customer is saying, Dean, what will give me the largest monthly check? And the fear of running out of money. Well, you're not going to run out of money. That's what's so neat. Once you annuitize, they're going to pay you, if you choose life only, you for the rest of your life. They have no living relatives, so it doesn't look like they got to take care of anybody else. This is becoming more and more, the answer is going to be life only. So which of the following options meets the needs of the customer? This is very much a test issue or test question. And the answer is C. I say, well, let's tell the insurance company that you only want to be paid for your life and your life only. And test question that will give you the largest monthly check. So some of these, I don't know about you, when I take a test, I like to get to the first question I know the right answer to. Hopefully you're not like 29 deep before you find one you like. 30. A customer is looking to maximize income. Which of the following lists ranks securities from the least suitable? Oh, don't you love the grammar here? Maximize income from least suitable, most suitable. So they're asking me to go from the lowest income to the highest income. From the lowest income to the highest income. So that's what this question is asking. Now, you should definitely know that an income bond or adjustment bond only pays interest when and if earned. So once I know that an income bond only pays interest when and if earned, I go down and I only have one answer that starts with an income bond. So it looks like it's got to be C, because income bonds or adjustment bonds only pay interest when and if earned. They're used in restructurings, then a convertible, and then a corporate bond. So from low to high in terms of income, it's a choice C. The answer choice C at 30 is C. 31, a customer who is bearish on the market and considers himself an aggressive investor is willing to risk 25,000. So a bear that's willing to risk 25,000 to pursue an investment that aligns with his bearish outlook, not minding the possibility of some loss, but wanting to get out, able to get out quickly if that begins to occur. He notes the substantial risk taken needs to be aligned with the upside potential. Too much risk and not enough gain wouldn't be acceptable. Which of the following would be aligned with the suitability? So this looks like a bear that wants to do something. It looks like shorting the calls is going to be out. We should definitely know shorting the calls is out, because he said, that would be unlimited risk. So that's out. And a hedge fund, we don't know what the hedge fund does. I mean, so, is it a short hedge fund? It looks like what we're going to do is buy an inverse fund, right? So an inverse fund goes the opposite direction. So in an inverse index fund, if the index goes down, the inverse index fund goes up. So it looks like the answer to 31 is A. A is an atom. 32. A person new to investing. So anytime they're new to investing, we got to be a little careful with them. The investor anticipates should not be needed for some time. So that's good. Time horizon is long. The investor proclaims, I want to stash it away and forget about it for years to come while it is growing. So a balanced mutual fund with both in equities and debt is chosen, but which share class would be most suitable aligning with this investor's objective? It's the B share, right? Because the B share has a contingent deferred sales charge. If they're in it long term, that will disappear. And so the answer to 32 is B. The B share class is suitable for an investor with a longer time horizon. So B share. 33. A new customer, another new customer, so not new investor, new customer, no other holdings, so I guess they are a new investor, wants to invest $75,000 in XYZ stock. He feels the company looks sound, the industry looks great. He also notes that it currently pays a small dividend, adding to its appeal. At the very least, discussion should. So now we got to talk to this client about what he wants to do. It looks like a lack of diversification, right? I mean, you're going to put your entire $75,000 into one security. That's called selection risk. Easy way to avoid it is to diversify. And so I think we need to have a discussion about non-systematic risk, selection risk, and diversification can mitigate that. So the answer 33 is A. 34. A customer age 54 has contributed to a self-directed IRA and to an employee matching 401k since age 30. So they've been doing this for 24 years. Feeling confident about what has been done thus far regarding retirement savings, the customer wants to take one more step, funding an annuity contract to add additional monthly income once retired. With all funds currently allocated toward retirement invested in securities that are subject to market risk, the customer wants these new funds to be exposed to little or no market risk. The customer, preferably the latter. So don't you love this? So he prefers no risk to even little risk. One of the following would achieve that objective, but with a discussion regarding which risk. So 34, it looks like what we're going to recommend is a fixed annuity, right? Because in a fixed annuity, you have no investment risk. The insurance company has the investment risk. So fixed annuity sounds like the right answer here. And then it says we tell him also that that's not going to do well in an inflationary environment, that he's going to lose purchasing power. So even better. So 34, the answer is B. 35. A married couple in their early 60s who both intend to work another 3 to 5 years wants to fund a variable annuity to add monthly income to their retirement years. They've used all their other retirement investment vehicles, such as their IRA, their 401k, and they also have a small pension. So that's kind of a hint that we shouldn't be considering variable annuities unless an investor has maxed out all those other alternatives. They have $150,000 in savings to put toward the retirement objective and specify that each of them have worked hard towards saving these funds. Therefore, the protection needs to be for them as opposed to one or the other. It needs it for as long as they live. So which of the following would be most suitable and most effective? So it sounds like to me that what we want is for each of these people, you can't split it up. A is just nonsensical. But B says a single life with period certain contract, one of the spouses with the other named as a beneficiary. That sounds, given that answer set, like our best alternative. Let's see what C says. A single joint with last survivor, that's even better, right? So now you're telling the insurance company that you want to be paid for your life, and then you want the spouse to be paid for the rest of his or her life. And so it sounds like C is even better than period certain. So we'll go for C as in Charlie. C as in Charlie. 36. Your customer with an annual income of $385. Wow. Investment portfolio of $4.75 million. Wow. Has always liked potential and real estate as a potential investment. The customer has recently identified real estate investments offering tax credits. So that means it's either low-income housing or historic real estate, because those are the two that do that. You should definitely know tax credits can be provided by low-income housing, Section 8, or historic real estate. Which of the following would be suitable investments to discuss? A REIT, there we go. Historic rehabilitation and government-assisted housing. I like that one. That's pretty much a aim and shoot, point and click question on your Series 7. Or direct participation program is, the fancy word for partnerships, because you're making a direct investment. There's no corporate wrapper, right? So the answer 36 is B. 37. Your customer is approved to use call options, strategies, and positions. All option strategies. Having a discretionary account, however, the customer has instructed you not to use any positions having unlimited loss potential. Considering that direction, which of the following positions would still be suitable and can be used in the discretionary account? So you're not supposed to exceed your discretionary authority is the point. And I don't have discretionary authority to expose you to unlimited risk. So long calls and puts, you lose the premium. Long straddles, you lose the premium. And spreads, you either lose the net debit or the difference in the strikes less the credit. So A doesn't have anything in it that exposes the customer to unlimited risk. So I like A. Let's see what else I have here available to me. So I'm going with A. B says long and short straddles. Short straddles have unlimited risk. Short calls, unlimited risk. Short puts don't have unlimited risk, but if any part of the answer is wrong, the whole answer is wrong. So C, short spreads, not a problem. Short straddles, short calls, So the answer 37 is A. 38. A high net worth investor has the following portfolio mix spread across a number of individual securities and products: 50% in equities, 15% in debt, 35% in high yield bonds. Which of the following would best describe this investor's investment style? Well, I missed some of these because I think it's not as aggressive as it could be. But the thing that makes it aggressive is the 50% in equities and then 15% in options. Oh, my God. And then high yield bonds. Yeah, now there's no doubt. First, I was thinking maybe it's not as aggressive as it looks like. But boy, once I go through the asset allocation, I go, yeah, that's pretty damn aggressive. You got half in stocks, 15% in options, and 35% in junk bonds. That's pretty damn aggressive. 39. An investor at age 38 with a net worth of $550,000 is considering a large investment geared toward growth. She's not interested in income. That's helpful. That's a hint, right? So we're going to toss out anything that has an income stream. She states, I pay way too much in taxes. I don't want to have to pay more than I want to. Which of the following investment options would be most appropriate given this limited information? So sometimes we have to make recommendations given that there's a limited fact set. And so here, let's go through this. Utility companies with a turnover ratio of 25%. That doesn't sound right based on the tax discussion and based on not being interested in income. Fund B, investment companies that have capital appreciation and they turn over the portfolio over 100%. So again, capital gains tax is a transaction-based tax. And if they're turning over the portfolios, capital gains distributions are going to be distributed to her and she's going to owe taxes on that. So that doesn't sound good. Fund C, investing companies with long-term growth potential. There we go. And a turnover ratio of 25%. So given that answer set, that sounds like our best answer, right? Because turnover means the fund is not going to be as tax efficient. And why would you be turning over a utility fund? That's just kind of nonsensical. So given this answer set, C is our best answer. All right, our last one, ding, 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 our last one. Is at 40 case studies, and here's case study number 40. For which of the following scenarios would a deferred comp plan be a suitable recommendation? A business owner wants a retirement plan to benefit the younger employees, and deferred comp is for our higher paid staff of a corporation. B, an employer has a handful of highly compensated employees. Yeah, there we go. I typically use Schwab, and I use like Walt Bittinger, Walt's the CEO. We say, listen, Schwab pays you so much money you can't possibly spend it. And good news, you can participate in Schwab's deferred comp. The answer here is B. And then you as a new Schwabby say, hey, I just passed my 7. How about deferred comp for me? We say, no. That's for our higher end employees. You got a long ways to go before you qualify for Schwab's deferred comp. We can discriminate. We can discriminate on deferred comp. Now, if you're a new Schwabby, your 401k looks exactly well Walt's in terms of the match and how it works. We can't discriminate, as it relates to qualified plans under ERISA, but we can certainly discriminate when it comes to deferred comp. All right. Well, anyways, I hope you found that helpful. We'll put this in the playlist. This now makes, as I said, our 4th suitability content available on the channel. We have suitability in 60 minutes. We have suitability yes or no. We have 50 suitability practice questions. And now we have 40 case studies. And I'll be putting this up. Stop share. And if you have any recommendations you'd like us to put into the channel, just let us know. And I'd be more than happy to consider any lecture requests. As my friend Brian Lee says, take the test. Don't let the test take you. And I'll see you for whatever our next installment is.